The most dangerous trap in the market is not a sudden crash or an obvious collapse. Those events are visible and usually arrive after damage has already been done. The real danger lies in the enthusiasm that is deliberately engineered before the decline begins. Traders are trained to celebrate breakouts, to believe that the moment resistance is cleared, opportunity has arrived. When a stock pushes through a well-known level with strong volume, most participants assume the path upward is now open. In reality, that moment often marks the completion of a professional selling operation rather than the start of a genuine advance. To understand this, the market must be viewed not as a place where opportunity is freely created, but as a mechanism through which wealth is transferred from the uninformed to the informed. Large professional operators do not profit because they predict the future better than everyone else. They profit because they understand crowd psychology and the structural requirement of liquidity. When institutions or large pools hold millions of shares, they cannot exit those positions quietly at low prices. Low prices attract few buyers. To sell large inventory, they must first create high prices and strong demand. This necessity gives rise to what is known as the distribution phase. During this period, the stock is held in a high trading range, often for weeks or months. Price appears strong, but progress is limited. Headlines are supportive, small breakouts occur, and the stock continues to attract buyers who believe accumulation is taking place. In reality, these minor advances are carefully managed to maintain optimism, while professionals steadily sell into that demand. Marginal new highs during this phase should never be interpreted as strength. They are part of the process of keeping buyers engaged while inventory is being quietly transferred. The culmination of this process is what appears to be a decisive breakout above a major resistance level. This move is often fast, aggressive, and accompanied by intense volume. Financial media celebrates it, analysts issue upgrades, and the public rushes in. However, this move typically serves two professional objectives. First, it forces early short sellers to cover their positions by triggering their protective stops, providing immediate buying pressure that professionals use to finish liquidating their holdings. Second, it draws in the largest possible number of late buyers, those driven by fear of missing out, who provide the final liquidity needed for complete distribution. This final surge is not evidence of strength. It is evidence of urgency. Professionals require high prices and emotional buyers to complete their selling. Once this transfer is finished, the supporting bids disappear. At this point, volume often remains extremely high, but price makes very little additional progress. This imbalance between volume and price movement reveals absorption. Every new buyer is immediately met by professional selling. The stock becomes heavy and unresponsive despite intense activity, which signals that supply is overwhelming demand. After the breakout fails to sustain itself, price often falls back below the original resistance level. This failure marks a critical shift in market structure. The visible resistance that was broken represents the supply wall, while the deeper reservoir of sell orders represents the supply pipeline. Once price slips back below the breakout level, the wall has been breached and the pipeline opens. Selling pressure is no longer constrained, and the market transitions from distribution into markdown. Following this failure, the stock usually attempts a recovery rally back toward the breakout level. This rally is typically weak and occurs on noticeably reduced volume. This lack of demand confirms that buying power has been exhausted. The traders who bought the breakout are now trapped, hoping price will return to their entry. Professional money, however, is no longer supporting the stock. The rally serves only to confirm that the former breakout level has become firm resistance. The most reliable confirmation of a true decline comes when price breaks below the last meaningful reaction low within the distribution range. This level represents the final internal support that professionals maintain to keep the structure intact during distribution. When this support fails, it signals that selling pressure has fully taken control. At this point, stop-loss orders from late buyers are triggered, converting into market sell orders and creating forced liquidation. This forced selling accelerates the decline and provides strong downward momentum. While the initial breakdown confirms weakness, the lowest risk short opportunity often occurs on a retest of the failed breakout level. Markets frequently return to prior breakdown points. When price rallies back toward this level and is immediately rejected on low volume, it confirms that supply remains dominant. This setup allows for precise risk control with stops placed just above resistance, while offering substantial downside potential as the markdown unfolds. Throughout this process, price action must be interpreted alongside crowd psychology. Hidden supply breakouts almost always coincide with peak optimism. Positive headlines, analyst upgrades, and bullish narratives tend to reach their maximum intensity at the same time that professional selling is concluding. This alignment is not accidental. The narrative provides justification for the public to buy aggressively while professionals exit. The disciplined speculator learns to distrust enthusiasm and rely instead on price and volume behavior. Once the supply pipeline is fully open and forced selling begins, the decline often feeds on itself. Margin calls, stop-loss cascades, and new short selling combine to push price lower than most expect. During this phase, patience is essential. Covering too early forfeits the true benefit of understanding distribution. The market rewards those who recognize the mechanics of supply, liquidity, and human behavior rather than those who chase excitement. In the end, successful speculation requires observation, patience, and emotional restraint. The breakout that excites the crowd often marks the end of opportunity, not its beginning. By waiting for failure, confirming structural weakness, and acting only when the tape authorizes the move, the speculator aligns with the true forces that move markets.